I've been helping people with problems with their mortgages for many, many years. My name is Mendez. I'm a bankruptcy, loan modification, and real estate attorney here in Miami, Florida. I was around in 2008 for the last crash, and I'm seeing a lot of the same things that happened then are happening again. History is repeating itself. I'm going to say something right now that's a little bit controversial, but hear me out, and I think I might be able to give you some insights on human behavior and how you can avoid defaulting on your mortgage and moving forward outside of the coronavirus financial crisis and getting on with your life. Most forbearances equal default. Most people that go into forbearance will default on their mortgage if they don't understand the process and don't understand human nature. I'm going to explain what you can do to avoid this and how you can get on with your life. I've been helping people for a lot of years, specifically with their real estate, loan modification, and bankruptcy issues. All of these things are tied together. I know debtors. I know the problems that a lot of people are going through right now, specifically what's going on in their minds. Now, there's been some pretty big news in the last couple of weeks about forbearances and what it means for people who are in forbearances and what's going to happen to them after March of this year, 2021. The biggest news is the government has announced a 3-month extension on forbearances that are covered by the CARES Act. What that means is if you requested a forbearance in March of 2020, you now have the right to ask for 3 more months of extension on your forbearance, which means that you will be in a forbearance for 15 months. That means you haven't paid your mortgage in 15 months. Now, that can sound like good news for a lot of people, but it actually might be bad news, and I'm going to tell you why that is in a second. Now, the biggest thing to understand about this forbearance request and extension is it only covers CARES Act mortgages. We've talked about this in other videos, and you can go back and watch the other ones to get more information. But just a quick recap. CARES Act mortgages are mortgages that are federally backed. And what I mean by that, FHA, USDA, VA, Fannie Mae, and Freddie Mac. If you have one of those mortgages, you might actually not know that because the bills you get don't say these terms on them, but they are, and you probably already know that you have one of these mortgages. But if you have one of these mortgages, this is your investor, that means that right now you can request 15 months, up to 15 months of forbearance if you started in March of last year, and therefore you can be in a situation where you're not paying mortgage for that long. Now, the rest of you, which is about 40% of the people in the United States, do not have CARES Act mortgages. These are private lender mortgages, and these are the ones on here on the left which say that you probably aren't going to get an extension of 3 months, but you might, depending on your lender. Those people need to talk specifically with their lender to see what options they have and what's going on with their mortgage. The thing that you need to understand about all of this is that when you request a forbearance, and the forbearances that I've seen in the past are related to hurricanes, because we're here in Florida, and I've seen a lot of forbearances throughout my career. Whenever there's a hurricane and people can't pay, the government generally gives a certain period of time that the people can get out of paying their mortgage for a few months, and then whatever happens at the end of that happens. Now, the majority of the people that I've seen that have requested forbearances in the past result in a default. And what that means is they get their 3 months or 6 months off, and then at the end, for whatever reason, which I'm going to specifically talk about in a minute, they are unable to get back to paying their mortgage. Now, in the current situation, the CARES Act mortgage people do not have to worry about a lump sum payment at the end of the 15 months. That means that they're not going to have to come up with 15 months of payments and pay in a lump sum. However, that does not necessarily guarantee that they're going to have to pay it, that they're not going to have to pay extra every month. I have already seen some people who are requested to pay all they owe in 12 months. So you'll have to make decisions as to what you're going to do at the end of the forbearance, and you have to make sure that you're doing the right thing for you and your family. The non-CARES Act people are pretty much on their own. I would suspect that a lot of people are going to be in a bad situation when they come out of the mortgage forbearance period if they don't have a CARES Act mortgage, because a lot of these banks are going to ask for a lot of the money up front or a very short and fast repayment, which could double your mortgage payment. So make sure that you're talking to your bank and make sure you understand what is going to happen. Now, the reason that most people end up in default, and the secret of everything that we're talking about here, is first of all, is misunderstanding the process. Now, what that means is that they don't understand the risks of what it means to take a forbearance when they requested the forbearance in the first place. A lot of people said, oh, free money, no payments for a few months, let's do it. The problem is that when you started that process, you didn't understand how you were going to get out of it. Now, a lot of people were forced into it because they lost their jobs, and this is the only way to keep their homes. I'm not judging anyone, and nobody should judge you. But the problem is that a lot of people entered into forbearances without understanding at the end what's going to happen to them. So again, when they reach the end, they hit a situation where they get a letter from the bank saying you must repay us in a very short period of time or in some form that they can't afford, and then they lose their home. Now, even the CARES Act people, who are not the ones who are going to look at the lump sum, are running the risk of losing their homes at the end of the forbearance. And I'm going to tell you a secret, and this is something that I've learned throughout the years of representing debtors in different situations. A lot of times when somebody stops paying their mortgage, they lose the habit of paying the bill. What that means is most people have a mortgage payment that is their largest bill. That means for the whole month, while you're preparing to pay your largest bill, you are cutting back on other things to make room and to save money for that big bill that's coming at the end of the month. If you have lost the habit of doing that, and all of a sudden there is instead of paying $2,000 a month in mortgage, you have a $2,000 raise, because essentially that's what happened, and you don't have the habit anymore of cutting back your payments and your other expenses for the month, then you might make the first payment, but the second payment becomes very difficult. And the third payment might be impossible, because all of a sudden you have cars that you didn't have before, you have expenses you didn't have before, you have expectations from your family and from other people and from yourself of expenses that you cannot actually afford. And this is a situation where human psychology kicks in, and a lot of people at that point default. I've seen this over and over and over. So you need to prepare yourself emotionally and psychologically for the end of the forbearance. What I mean is, if you are in a situation, even if you're a CARES Act, where you're not going to have to come up with a lump sum, but in 3 months you're going to have to start paying a mortgage, you better start preparing for that now. I would start acting as if the mortgage payment was due today and put that money into the bank. So if you have to come up with $2,000, pretend like the $2,000 is coming due at the end of the month, and you need to come up with it, or at least a big percentage of it. You need to act like that and save that money, because if you don't, a lot of people cannot resist the urge to continue living the way that they were living before, and paying things that they can't afford, and taking vacations and things that they really can't afford, and then they lose their homes. This is a very real phenomenon. I've seen it with my own eyes, and the banks know this. This is not something I've come up with. This is not Diego Mendez inventing this. The banks understand this. They know that when a forbearance happens, you are at risk of default for a very long time. The thing you need to do in this situation is save your money, and if you want to apply for loan modification, you should apply during the forbearance period, because if you really can't afford this payment at the end of the forbearance, you need to do something to make the payment affordable, so that you can then continue making the payment beyond the 15 months or year or whatever that you have in forbearance. So that's it for now. My name is Diego Mendez. My channel is called Debt Law. I am a bankruptcy, loan modification, real estate attorney here in Miami, Florida. I've been doing this for very many years. I want you to please subscribe to my channel. That helps me keep going with this show and keep making these videos, giving you my insights of hard-fought information that I've accumulated over the years of helping thousands and thousands of people save their homes from foreclosure and other disasters. Subscribe, Diego Mendez, Debt Law. Thank you very much.